Welcome to the Better Agent Podcast. If you're a real estate agent that's looking to grow your business, then you're in the right place. Whether you want to go from 5 to 10 transactions a year, or 10 to 50 transactions per year, or more, well then this show is for you. I'm Josh Lavick, your host for the Better Agent Podcast, and in each episode, we'll bring you the tools, tips, and tricks directly from myself and some of the best leaders within the real estate industry. We have one goal in mind, and that's to boost your production and elevate your real estate game. Let's dive in and start creating a better real estate experience together. Welcome to the Better Agent Podcast. I'm your host, Josh Lavick, and today we're going to be talking about real estate again and how to improve your business. And I'm here joined with Barry DiRaimondo. He's the CEO of SteelWave, and they do a bunch of commercial real estate and other investment real estate. And well, I guess without saying too much more, I guess I'll let Barry kind of talk and take it from here and share a little bit more about his background with our guests.
Sure. Well, SteelWave, just by way of background, we're commercial real estate investors and developers on the West Coast. You know, our markets are all of the main tech hubs. So what we do is, you know, our verticals are office, it's industrial, it's life science, and it's mixed use. So one way of thinking about this is we basically think that our job is to provide really differentiated work, live, and play environments for the innovation workforce. So if you look at our markets, it's Seattle, it's the Bay Area, it's LA, Orange County, San Diego, Denver, and Austin. And the commonality is tech, whether it's media tech, whether it's traditional tech, whether it's AI, whether it's defense tech, creative tech. It's all this sort of innovation workforce. And that's really our target audience. It's not back office. It's not insurance companies. It's not lawyers. It's not accountants. So we have a very specific target audience that we're going after. And we've been doing it for a long time. You know, I think through our predecessor companies, we've been doing this really since the late 70s.
Wow.
And, you know, before we were SteelWave, we were Legacy Partners. Before we were Legacy Partners, we were Lincoln Property Company. And each one of those transitions was basically a jersey change where, you know, we kept the infrastructure, we kept the real estate, we got new cards, we got a new website, you know, and everything continued on. But I think over that period of time, we've probably done upwards of $18 billion investing in this stuff.
Wow.
And most of what we do is really heavy touch. So we acquire assets and completely reposition them or build them from ground up. So we don't buy fully leased assets, core assets, and hang on to them. You know, we kind of create those assets and then sell them. So that's background on who we are and what we do and where we do it.
Very cool. Well, that's we've certainly seen lots of changes in the technology world and technology spaces. So lots of growth in those sectors. So it makes sense that you guys would have a pretty robust business of having done $18 billion, as you said. So, and you've been with this company for, you said something, the 1970s throughout that, most of that time?
No, I joined this company when it was back in the Lincoln Property days. I joined in 1985.
1985. Okay. Sure.
Yeah.
Still quite a while. And I assume you've seen quite a bit of growth over that time frame?
We've seen a lot of growth. You know, we've seen a lot of ups. We've seen a lot of downs. You know, we've been through a few cycles. I think one thing that's good and bad about having a tech-heavy footprint is that when the market goes through a decompression, you know, the tech-heavy footprints fall the farthest.
Okay.
But they also tend to recover the quickest, right? So, you know, as you go through, whether it was the GFC or the RTC days or any of these big corrections, you know, in these tech hubs, you have giant corrections. And we've had one as we speak. You know, we're in the middle of a major correction that is probably every bit as severe as the GFC days.
Wow.
You know, for commercial real estate right now, given the value implosion
Sure.
from the increased interest rates. So I think while it looks pretty bleak at the moment, and if you just do traditional analysis, you'd say we'll never recover until the end of the century. But, you know, we know that all of our markets recover in a hockey stick format.
Yeah.
And we're actually starting to see leasing happen right now in these markets. So that's the
Sure.
good news.
Yeah, I was curious. I mean, just hearing about some of the markets you serve, and I don't know how much, and again, I'm mostly in the residential space, so I don't deal as much in the commercial space. You know, I'm in Madison, Wisconsin, South Central Wisconsin, so not exactly in a hub. We've got some technology companies in our area, probably Epic Systems, you're probably most familiar with. Maybe they do electronic medical records. That's probably the biggest tech company in the Madison area, but totally different than what you guys deal with. But I was curious about like Silicon Valley Bank. I mean, just with everything that happened with that blow up, did that affect you guys at all in terms of your developing and
Not really. I think indirectly it affected us because I think a lot of the startup companies,
yeah,
had assets sitting at Silicon Valley Bank. And I think Silicon Valley Bank was big on the VC side, candidly. So,
sure.
when that was starting to blow up, certainly for the early stage companies, it had some big impacts. So indirectly, it impacted us just to the extent that they were sitting in our buildings.
Hmm.
There was a lot of concern.
Yeah,
I think it's all been resolved, but I think what you saw there was probably endemic of what a lot of regional banks are going through right now. I mean, regional banks right now, I think you're going to see a giant consolidation of regional banks just because they've got such giant real estate exposure.
sure.
And, in the commercial real estate world, certainly in these tech hubs, there's a lot of debt that's underwater.
Yeah.
And candidly, the difference between today and the GFC is in the GFC, you had low interest rates. So you could extend loans and kind of hope for a better day
Mhm.
by just posting interest reserves. Today, you just can't do that because, the cost of capital is so high
Yeah.
that it makes it very difficult. So, there's a lot of restructures going on. I think you're going to see a lot of debt getting written off,
Okay.
especially with these regional banks. A lot of equity has just been washed. So that sort of has to work itself through the system.
Hmm.
And it's been working itself through the system slowly. And I think 2025 will be really when you see, the crescendo, if you will, of people come to terms with real values and debt starting to transact and equity starting to transact. It's been a little bit of a Mexican standoff for the last 18 months.
Sure.
But I think 2025, you'll see it wash through the system and the
Or
world start back up again.
is it because like a lot of the loans they are kind of coming due where that people are having to refinance at a much higher rate and now suddenly the values aren't quite there? Is that a big part of it?
Well, I think you've had a lot of that. I think you've got that happening, but that's been happening, and I think the banks have been unwilling to really write down their book of debt,
Hmm.
candidly, because a lot of these regional banks couldn't. They didn't have the reserves set aside to take the losses with the reserve requirements.
Hmm.
So they've had to take time to build up the reserves so that they could actually take the losses
Mm.
because they simply didn't have the cash set aside to deal with setting aside those kinds of reserves. So as they've been able to build up cash, they're able to take the losses. And
Okay.
I think next year will be when you see a lot of it. I think a lot of them know how bad the portfolio is.
Mm.
They've just been precluded from admitting it to the regulators.
Sure.
And I think the time is coming where they sort of have to do it.
Okay. Yeah. Yeah, so this is reminiscent of, I mean, I've been in the real estate market, like I said, 19 years. So I remember starting in the residential world, seeing all the residential values shifted back when in 2006 when the last recession hit. And, I don't think we necessarily saw that as much in the commercial market. But, based on what you're telling me here is we're kind of we're going to definitely experience a revaluation in the commercial markets. So do you see that as
Well,
some big opportunities potentially for other investors coming in and maybe
oh,
snap
I think
up
it's a
some of
huge
these
opportunity.
properties?
Yeah, I think it's huge opportunities. Unfortunately, a lot of the traditional institutional investors are dealing with all their legacy issues.
Mm.
So it's a little bit of a chicken and the egg.
Okay.
Yes, it's a great opportunity, but you're dealing with all your own equity write-downs at the same time that it's a great opportunity. I mean, to give you a sense, what was trading in San Francisco in the
Mm-hmm.
way of a office space, what was trading for, pick a number, 850 to $900 a foot is
Okay.
now trading for 250,
Wow.
right?
Yeah.
And you could really go to most of the markets we're in, and candidly, I'd say the markets we're not in, and you've still got that kind of massive drop. Maybe the numbers are different. In Denver,
Yeah.
maybe it was 450 a foot is now 100 a foot,
Uh-huh.
right?
Yeah.
But the magnitude's still the same.
Yeah. Holy cow. Yeah. That's like 25% basically is what you're saying, kind of where they're at, huh?
I mean, so what it tells you is that the equity's gone
Yeah.
and the debt is probably 50% impaired in
Yeah.
many instances.
Okay. Huh. So where do you position Steel Wave? How does Steel Wave reposition to come ahead on this?
Look, I think it's the best buying opportunity since the RTC days. I mean, it really is.
Yeah.
I think the institutional equity has been reluctant to come off the sidelines.
Yeah.
I think in 2025 they will. I mean, no one wanted to hear anything that said tech and office in the same sentence,
Yeah.
right?
Right.
Because that's probably where it's been impacted the most.
For sure.
But I do
People are
think,
having their calls on Zoom and traveling, working from home, right? So, yeah.
yeah, I think you've had this work from home phenomena, which has sort of impacted things.
Yep.
It's people are coming back to work. Who's not coming back to work though is the government.
Yeah.
One thing people don't realize is that between federal, state, and local governments, and just broadly speaking, I think you've got 25 million employees, government employees. 9 million of those employees are working full time from home. And I'm including the Defense Department, I'm including police and fire. And, those guys are all back to work.
Right.
But, the IRS and the GSA, and go down the list, these guys are all working from home.
Yeah.
Which, and they're probably not coming back to work anytime soon.
Sure. Yeah.
And that's had a big impact in some of these markets that are very government top heavy, like DC.
DC for sure. Yeah. Actually, I have a good friend of mine who he works for the federal government in DC and works remotely, work just like what you're talking about, works from home, and
Right.
he just got exactly what you're saying. He got just, confirmation that he can continue doing that at length. And so maybe he flies to DC a few times a year, but that's about it.
Yeah. And we're seeing that. Obviously, we deal with the local governments all the time,
Yeah.
with permitting and stuff like this.
Yeah.
And trust me, it's not like the government was hyper efficient before working from home.
Yeah.
And they're much less now. So, the time for permitting and all that stuff is taking much longer. It's a much more fragmented process.
Right. Wow. All right. Well, I appreciate you sharing a little more on your background and what's going on and, a lot of things going on. So part of my goal too in this podcast is to try to reach listeners and viewers and things like that would be really interested in growing either their own real estate business or portfolio or something like that, from one level to the next. So, from my standpoint, like as a residential practitioner, people that are looking to maybe going from selling 10 homes a year to 40, 50 homes a year. But maybe from your perspective, it's developing from, a few rental units on up to maybe a few hundred rental units or something along those lines. Is there anything maybe that you could share about your process and experience in terms of how you run your business and how you've seen it grow and adapt over time that could speak to just some of the things that you've found to really move the needle in terms of your growth and change over time?
Look, I think you have to really define what your business ethos is and then stick to it. I think the biggest mistake people make is they don't really understand. They haven't really defined exactly who their target audience is and what they want to do when they grow up, if you
Yeah.
will. And they get distracted by lots of different types of opportunities.
Yeah.
You know, we know who we are, we know what our strengths are, and we know what our weaknesses are. You know, we play to our strengths and we play against our weaknesses, and it's that simple.
Yep.
You know, my journey into real estate was not direct by any stretch of the imagination.
Mm-hmm.
I'm actually a biochemist by training.
Ah, nice. I have a biology degree as well, and now I sell houses. Here we go.
So everyone in my family was a doctor.
Okay.
And that was kind of the family path. You're either a patient or a doctor. And I said, well, being a doctor is probably better than being a patient, so I'll be a doctor too. So that's, one of the reasons why I went down that path.
Yeah.
And after I graduated from Berkeley, I spent a little bit less than a year doing research to figure out if I wanted to go on and get a PhD.
Mm-hmm.
And I hated it. And I said, well, that's not what I want to do. So I'll default to going to med school. So I applied to med school, got into med school. And in the interim, I had started up a small construction company. And in the beginning, we were doing fences and decks for houses. And then it morphed into doing kitchens and bathrooms. And then it morphed into building spec homes. And when I decided I was going to go to med school, I sort of stepped back, and everyone else in my family is a doctor. And I sort of saw the lifestyle that they were dealing with going through med school and going through internship and residency and all that stuff. And I finally came to the conclusion that I did not want to go to med school. So at the time, we were doing a major rehab of a guy's house who was a bond trader. And I sat down with this guy and I said, what do you think I should do?
Yeah.
And he said, you should go to business school. He said, it'll just give you maximum amount of optionality and you'll figure out what you want to do.
Yeah.
So I ended up going to business school with an eye towards either leveraging my technical background and coming out of business school and going to work for a Genentech or someone like that, or leveraging my construction background and going to work for a developer. Right?
Yeah.
Well, it just sort of happened.
Yeah.
That I ended up going to work for a developer. Right? But it's sort of come full circle because now a big part of my business is providing work environments for life science companies like Genentech, or Merck or, whoever. So while I'm still in the real estate business,
life
a
sciences.
piece of that business is very science oriented.
Yeah.
It's not always going to be a direct path.
Yeah.
To sort of get there. Sometimes it's a little circuitous, and for me, certainly that's been the case.
Yeah. Oh my gosh. I'm really resonating with your story here because, like I said, I also have a biology degree, and I remember I had a lot of friends that were also had biology degrees or biochem or whatever, and went to med school, and I sort of came to that same conclusion that maybe I didn't want that lifestyle of going to med school and everything else. And so instead I moved to California for a little while, thought I was going to be a winemaker, lived in Napa Valley. Then I moved to Colorado for a while, lived there, and then moved back to Madison. This is where I grew up. I was going to be maybe a science teacher. Well, then I was substitute teaching for a while and then kind of forgot how much little kids in high school and whatnot don't care about school. And so it really was really discouraging for me. So I changed paths again, sort of accidentally, and fell into real estate as well. My parents are both in real estate. My dad's an investor. My mom was a realtor, but it was kind of interesting just how it finds you. I think a lot of people in this industry and in real estate in general, it's like somehow it gets attractive to a certain type of person and it kind of finds you, I think, in the industry. And so, one thing leads to another. And I think it's interesting too, just to find your niche. That was the first thing you said to me when we started this call, right? Like you told me flat out, you already knew who you are, who your firm is, who your customer is. And, it's one of the things too that we talk about when we onboard agents to our team is like, craft your identity, determine who you are, who you want to be, who you connect with, who you connect well with in as an agent. And so it's very much in terms of similar. I think you've defined very much who your ideal customer is versus who it isn't, and then, building everything, all of your energy around that. So yeah, I just really resonated with that. So that's cool.
Yeah, look, I think the work environment that the innovation workforce plays in is very different than the work environment that back office or insurance companies pay for. I mean, when you think about it and you start thinking about best practices, with tech companies, they talk about design teams and they talk about engineering teams. They don't talk about design individuals and engineers, right? So you have to build a work environment that's really allows for a lot of collaboration and teamwork, which is very different than like a law firm that's got a bunch of siloed private offices, right? So you just have to understand who your target audience is and then figure out what their wants and needs are and accommodate them. We settled in on the tech sector for a lot of different reasons. Reason one is the profit margins for tech is generally higher than, say, back office or insurance and fire and stuff like that. So the profit margins of the companies are higher.
Okay.
And when you look at the costs, their occupancy costs, their real estate costs are usually a much smaller percentage of their overhead than back office. And they view their real estate really as more of a strategic asset as opposed to a cost center. Right? All of which is good if you're the real estate practitioner, right?
Yeah.
So our job is to create environments. Tech companies spend an enormous amount of money sort of building their brand and their culture around that brand.
Totally.
And, when they think of their real estate as an extension of that brand, so that they can attract employees to go work there, that's good because you can differentiate the real estate. If all you're doing is building commodity real estate, the only thing that differentiates you is price. And if you're going to compete on price, your margins are going to be pretty thin.
Walmart's going to beat you.
Yeah. We don't compete on price. We compete on, is our space differentiated enough to attract employees? That's kind of how we view it.
And, I think that makes a lot of sense.
And that's especially important today, when you're competing with someone's couch at home.
Yeah.
Right?
Yep. No, absolutely. I think, I've had this conversation several times with a lot of the other agents that I collaborate with. We do a mastermind every week on Mondays usually. And, they're agents and teams from around the country. And, every week we kind of go through and talk through different challenges we're facing and topics that we usually cover. And one of the things definitely we always talk about too is trying to be different, right? Be different and if, you have to differentiate yourself in some way. And whatever that is, otherwise you are only competing on price and you are a commodity and, you're definitely not going to be able to charge a premium price or a premium commission or whatever it might be in order to capture the maximum value that might be there. So yeah, I think it totally makes sense.
Well, and I'm sure this work from home thing has impacted your business. People are thinking about workspaces at home and,
absolutely.
It's a little bit different. What you haven't seen come to the forefront is the OSHA issues. So now you're working at home, you get up, you trip over your dog and you break your arm.
Sure.
Now, who bears that burden of cost?
Oh yeah. Who makes that workman's comp payment, huh? Yeah, I get it.
No. You haven't seen that stuff, bubble to the surface yet, but you will.
Yeah, I can see that for sure. So yeah. Well, cool. Well, I know we've chatted a while. I guess I could go a couple different directions, but just anything else maybe you wanted to share or us to cover on the podcast to kind of talk a little further that might be interesting to help our viewers become better agents, better practitioners?
There's one thing that's going on out there that a lot of people aren't aware of. And, this notion of Web 3.0 or digital securities, people think of Bitcoin and stuff like this, right?
Sure.
I can tell you that the world of ownership of real world assets and how these things are transacted, this ecosystem is going to change the way that takes place.
Yeah.
And you don't hear a lot about it
Sure.
because it's very different, but it's incredibly disruptive.
Like using
And
Bitcoin to go buy a piece of land or an office building or something like that, or what is that what you're saying?
Or the notion of tokenizing an office building, right? So you wrap the ownership instead of it being a traditional joint venture or whatever, you wrap it with digital securities, tokens, call it what you want.
What do you mean wrap
And
it? What does that mean? I don't understand that.
well, instead of someone owning a limited partner interest
Okay.
in a building, they'll now own a token in the building. And you can wrap a building with 1 billion tokens.
Okay.
You can have $1 tokens, you can have $50,000 tokens, you can have whatever. And the whole notion is that you can trade those tokens either peer to peer. I can sell that token to you directly,
Okay.
or I can list that token on any number of regulated digital exchanges and sell it off an exchange, right?
So you think we're going to start seeing this more and more, and it'll be
I can tell you unequivocally, within 2 years, it will be the discussion. We're already seeing it. You know, we formed a subsidiary company called Steelwave Digital
okay.
because we saw it coming. And we started dealing with this probably 3.5 years ago when it was really early. I mean, we're early today, but we were really early back then.
Yeah.
And, you know, what we're seeing today, because I speak at a lot of these digital conferences,
Okay.
and the people who are represented at these digital conferences now is every one of the major institutional money managers are out there doing it. And they're building out all, whether it's Goldman Sachs, whether it's Franklin Templeton, you know, go down the list, Aberdeen, they're all building out their digital securities teams to basically wrap their financial instruments in digital securities to sell them to their clients. And the first things you'll see is the money market funds, and you'll see the treasury funds, you'll see bond funds get wrapped with these sort of digital wrappers, and they'll be sold. Then you're going to start to see things like real estate, venture capital, you know, some of these more illiquid assets.
Mm-hmm.
You'll start to see it. And to give it perspective, you know, you can create all sorts of classes of tokens. So let's say I own an office building for grins, right? I can wrap that office building with $1 tokens. So I could sell off a $1 token in an office building. You can buy 10 of them, so you get a $10 position in an office building.
Okay.
You can have senior tokens. You can have junior tokens, right?
Mm-hmm.
You can have tokens that give you ownership in the cash flow. You can have tokens that give you ownership in the appreciation of the building. You know, I could have a portfolio of buildings. You could have tokens that allowed you to participate in the red buildings or the ones that had even numbers in their addresses. And so the whole idea is that you can differentiate in ways that you can't do with traditional ownership.
Okay.
You can create all these different classes of tokens that you can trade.
And reach more potential buyers, it sounds like, right? Like
unequivocally.
Yeah.
Unequivocally. So it's coming, you know, and I think the Boston Consulting Group did a big study on this, you know, a little while ago. They think it could reach $17 trillion industry by 2030.
Wow.
Right. So it's a big change that you're seeing. And what you see is all the major institutional wealth management companies and money market managers are rushing to the regulatory table to have a seat at that table.
Yeah.
To box out the newcomers, because they want to make sure that whatever the regulatory framework is going to come out of this thing, and it's all happening right now.
Yeah.
They want to make sure it favors the old guard as opposed to, quote, the new guard. It's called regulatory capture.
Yeah.
they've got a name for it, and you're seeing it right now. I mean, it is big time. You know, when I started going to these conferences 4 years ago, it was all the crypto. It was the crypto world,
Sure.
right? It was these, people who had grown up in the crypto world. A lot of them were hyper wealthy because they were super early investors in Bitcoin and some of these other crypto things. And I mean, it was a different crowd. You know, I'd walk into these conferences, lots of body ink, lots of body hardware, crazy hairdos, people running around in pajamas.
Yeah.
I'd walk in, they'd think I was the FBI, right? Today,
Where's your tats, huh?
today, the pajamas have been replaced by sport coats and suits, and it's all the institutional players out there.
Yeah.
And they're all they're all spending a lot of money to build out their teams. So I think what you're going to see is not exclusively, but you're going to see a fairly wide segment of the market where, and it's going to apply to real estate as well as all other asset classes,
Sure.
are going to be owned and transacted with digital securities in a way that doesn't exist today. And I think you'll start to hear a lot about it over the next 18 months, and it'll be ubiquitous within 5 years.
Wow.
Yeah.
Okay.
Very different.
Yeah. Well, it certainly is very different. It's something I don't know hardly anything about, other than what I've read online or whatever about crypto and whatnot. And I just see all the volatile pricing swings and how people have, made tons of money and also lost tons of money. And so I don't feel like I know enough about it to feel confident in the direction it's going. I mean, I kind of feel like, at some point there's got to be sort of a winning currency that maybe wins out. And I don't know. That's kind of my general prediction, but I don't really have any idea. You probably know. If you're going to these conferences, you probably know way more about that than I do. So that's pretty interesting. So,
well, if you invested $100 in Bitcoin,
yeah,
in March of 2010, that $100 today is worth 210 million.
Holy shnikes! Wow.
Look at it. Berkshire Hathaway. A lot of people consider Berkshire Hathaway probably the best equity store of value on a diversified basis.
Yep.
Right. So if you own Berkshire Hathaway Series B, right, stock.
Mm-hmm.
Now Series A is the stuff, it's like 600,000 a share, and they said, well, okay, we got to break it into smaller shares so people can afford it.
Yeah.
Series B is about $450 a share.
Yeah.
And if you had invested, say, $10,000 a year starting 10 years ago, 2014.
Yeah.
So it's that your basis is $100,000 today.
Yep.
Your stock portfolio would be $240,000, right?
Yeah.
Which is pretty good, right?
Yep.
I think the CAGR's been like 18% for that stock.
Yeah.
If you'd done the same thing with Bitcoin, invested $10,000 a year starting 10 years ago, that portfolio would be $5.2 million.
Holy cow. Okay.
So, I think it's probably a pretty good store of value. Now it's volatile, but it's volatile,
Volatile, but still with a lot of runway, it sounds like.
Yeah.
Okay. All right.
Now what you're starting to see is public companies are starting to put it on their balance sheet as a store of value. There's 42 companies that have Bitcoin positions, publicly traded companies that have Bitcoin positions on their balance sheet as a store of value. Tesla's sitting on a bunch of it. MicroStrategies is sitting on a bunch of it. These aren't Bitcoin companies. They're just sitting on it.
Mm-hmm.
I mean, if you've talked to any of the candidates for president, Kennedy wants the U.S. to own 4.5 million Bitcoin as a store of value on its balance sheet. Trump, I think, has stated that if he wins, they want to put 1.5 million Bitcoin on it. So you're starting to see governments and you're starting to see publicly traded companies look at this as a store of value and put it on their balance sheets. And we're in the early stages of it,
Yeah.
very early stages.
Well,
Even though you've had this gigantic run up,
yeah.
I don't know what it's trading today, $65,000, $66,000, $67,000 a coin.
Wow.
A lot of people think it's going to run to $1.5 million easy.
Wow. Okay.
So
I better
but
sharpen my
you know,
pencil and do a little more research, I think.
but I think more importantly, I think just this whole Internet 3.0 and this whole digital security thing about how you can wrap real estate with digital securities and do so in a very creative way, I think really will impact the real estate markets favorably.
Yeah.
It'll just allow a lot more people to play.
More people be able to invest in buildings that you're doing and projects.
Yeah, buildings, houses,
Yeah.
whatever.
Yeah. Okay. I'll have to, I'm heading to a conference the end of October here, so I'll have to bring that up with some of the people that I'm attending the conference with. So I'll see if, see if I can dig into some
See
of
what
that.
they think.
Yeah, I'd love to hear it. Well, cool. Well, I appreciate you coming on the show on the Better Agent Podcast today and sharing a little bit more with our viewers. And again, my name is Josh Lavick, and I'm your host. And we've had a great conversation with Barry DiRaimondo from Steelwave LLC. And again, you're watching the Better Agent Podcast. Thanks for tuning in.
Thanks for tuning in to the Better Agent Podcast. I hope you found today's insights valuable. Don't forget to subscribe and leave a review if you enjoyed the show. Stay tuned for more tips, Q&A sessions, and sneak peeks into our 21-day challenge. To get full access of our show notes and more details on the 21-day challenge, go to abetterrealestateexperience.com. Keep striving for greatness, and I'll see you on the next episode.